Welcome back. Well, let's talk about a couple of companies then which came out with numbers. Morepen Labs is on our radar today. Q1 was a good quarter for them with improvement in margins and a healthy revenue growth as well. The company has raised 200 crores via QIP earlier this month. To talk more about the business, we have Sushil Suri, who's the chairman and MD of Morepen Labs, joining in now. Mr. Suri, thank you very much for taking the time out. Thanks very much, for joining in. We'll start with your revenue, because that was a good double-digit growth that you showed this quarter. I wanted to understand that within that, the medical devices, it's a relatively new business for the company as compared to, say, your APIs. It was up 20% this quarter on a year-on-year basis. What led to this 20% growth in the quarter? If you could break it up for us in terms of the domestic market, the exports, which are the segments which are doing well, and is it sustainable?
Yes, I think you raised a nice question. Is it sustainable or not? That way, I would say, Ekta, that this is an interesting model that we have a fixed base of customers who buy our strips regularly. Basically, in medical devices, we are into two businesses, primarily glucometers and BP monitor. So glucometer is like an annuity business. We keep installing the meters in the market, and when the customers buy meters, and of course for the lifetime, they have to buy the strips. So it's an interesting model. So as we speak today, so we have 1.2 crore meters in the market. It's like 12 million meters in the market, which is almost 20 to 30% of the market. So those meters keep on adding the strips. And if we stop selling meters, so certainly the growth would stop, but we keep installing more and more meters. That is what is adding to the revenue. So even if we add 10% meters extra, so we get 20 to 25%, 30% returns. That is on the meter side. Second is the BP monitors. So BP monitor also has registered a good growth, around 21% growth. So this is an interesting model. And more importantly, is it sustainable? That way, I would say it's just the tip of the iceberg. The Indian medical devices market has just opened up. And as per the Investment India, Government of India portal, so this market is only $11 billion. It's 90,000 crore.
So that point is taken. Just to get some figures out of the way then, medical devices is now what, 30% of your sales? So how 30%. How much do you envisage it will probably grow to, and by when?
Slowly this is certainly inching up. Last year it was 26%, now it is 30%, particularly this quarter it is 30%. So if it keeps growing at the same volume, I would say maybe in 3 years' time it will be around 40-45% of the business. But more important will be it's a long-term business wherein we do not see any ups and downs because we have a inherent customer base. It's not unlike in API, we have a B2B, wherein every quarter we have to find customers and every quarter whether they will buy or not. But sugar testing is one. If you are diabetic, then you are diabetic for the rest of their life, most likely.
All right. What about margins? Because last 3 quarters, ever since it broke into that 11% mark, it's maintained above that. In fact, now as we speak, it's around 11.3%. So should we consider 11% as the base now going forward? And what are the upsides here?
Mangalam, you rightly guessed that this is the base now, and as we go forward, and as earlier said that once we have installed the meters, I keep on selling strips, we obviously make more money on the strips, so our margins are going to increase in the medical devices certainly. And BP monitor also, last year we started 100% manufacturing in India. Of course, we are manufacturing everything in India now, but BP monitor last year was a full swing. So our margins are increasing in BP monitor also, our EBITDA is increasing. And by the way, this quarter was the highest EBITDA ever in last 40 years, thanks to all our backward integration in medical devices. And in API business, there is some confusion that because of the China factor, last 2-3 years were badly affected. I would say worstly affected on the EBITDA because the prices were going high. But this year, because of the softening of prices in China, the API margins have also returned back. So this is a good news, and we hope to sustain it. And the whole idea is that we keep on changing or evolving our product mix in such a way that the focus should be on the margins.
We take that point. Mr. Suri, while your EBITDA is at a historic high, what's also interesting is that it was only last year where your cash flow turned positive, cash flow from operations turned positive after 2 years of a lull. Even last year, EBITDA was 2 times your operating cash flow. And at the same time, the street is looking at your dividend payout. Your receivables have increased, as have your payables, along with your inventory, etc. as well. So, one wants to understand this year, what is the kind of operating cash flow that you would make? What would be the net working capital days? And at the same time, what is the kind of dividend payout plan that you have?
I would like to say that certainly the cash flow is a very big, complicated game. That net cash flow from operation. For a mid-sized company like ours, we hadn't had any capital event for the longest time, and we are a debt-free company. So our cash generation goes into working capital and capex both. So every year we do 40-50 crore rupees of capex, which is again going from the cash flow. So of course it is deducted from the operational cash flow. Second is the working capital. In working capital, of course, we have a normal working capital. There's no extra increase. Normal, typically 60 to 70 days for devices and 80 to 90 days for the API. So we are good to go there. The only difference is in last 2-3 years, when post-COVID, there was a more focus on the domestic market, and rightly so. The global markets were shut in a way. So we have seen that in the domestic market, the debtors are very high. And of course, the credit periods are high and the debtor serviceability is also very low. So we are now trying to cut it down. During this quarter, we have cut down the domestic sales to a little extent, just 8-9%. We are focusing more on the export. The debtors are less, profits are high. So domestic markets are again China based. So there is a lot of price fluctuations also. So we are trying to make these corrections. And certainly we are cash positive quarter on quarter. But now post this QIP, all our additional capex requirement would be met from the QIP funds, I would say, and the additional working capital would also be funded from there. So the operational cash flow would be much better utilized and much faster recovery and much faster turnaround than, because earlier we were going very slow in all things.
Okay, all right. We're going to leave it on that note, Mr. Suri. Thanks very much for joining in and speaking with us. So that's Morepen Labs. Stock is doing well. It's up around 5% They're expecting the medical devices segment to grow to around 40 to 45% of sales. And API margins have improved due to the softening of prices in China. Well, we need to take a short break, but up next we'll go full tilt on the markets. Manish Hatiramani of Deen Dayal Investments will join in with some trading calls.